Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Whoa, big changes are coming to your 2025 taxes. And, if you earn tips or overtime, you're going to want to listen up. A brand new law could mean a major tax break for millions of workers. But there's a little bit of a catch for this first year. So we're going to break down exactly what this means for you, how to claim it, and the one thing you absolutely must do to get ready. So get this, a new law could literally put thousands of dollars back in your pocket. I mean, it sounds almost too good to be true, right? Which brings us to the big question. What's the catch? And believe me, for this first year, it's a really important one you need to know about. And here it is. Here's the problem. For the 2025 tax year, the official forms, your W-2 from your boss, or the 1099s for you contractors, they just haven't been updated yet. They simply won't have the specific boxes you need for these new deductions. And that creates a reporting gap, which means the ball is in your court to figure out the numbers. But don't worry, the IRS has provided a workaround, and we're going to walk through it together. All right, let's dive right in with the first major break, the deduction for tipped workers. If you're one of the 6 million Americans who report tipped wages, this section is for you. So what exactly is a qualified tip in the eyes of the IRS? Well, the law defines them as cash tips. And yeah, that includes tips you get from a tip pool or some kind of sharing arrangement. Now, this part is really important. They have to be from a job that was already known for getting tips before the end of 2024. The IRS actually put out a list, so think servers, bartenders, travel guides, that kind of thing. Okay, you might want to sit down for this number. The maximum you can deduct for your tips in a single year is a whopping $25,000. That is a huge amount of tax-free income, but you have to know how to calculate it properly to claim it. Which, of course, brings us to the how. Since your W-2 won't spell this out for you, the IRS released special guidance, it's called Notice 2025-69, that gives us the official workaround for figuring out your total tips for the year. So, let's break this down. If you're an employee, you've got a few ways to go. You can use the amount for Social Security tips that's in Box 7 of your W-2, or maybe the totals from your monthly tip reports. Those are your Form 4070s. You can also add in any unreported tips you claim on Form 4137. Now, for you non-employees, say a self-employed tour guide, it's all about your own records, detailed tip logs, earning statements from booking platforms, or your point-of-sale reports. Okay, this next part is huge. It's some seriously good news, especially for 2025. Normally, there's this complicated rule that could disqualify you if your employer is in what's called a specified service, trade, or business. But for this first year only, the IRS is basically saying, don't worry about it. This little bit of transition relief makes it so much simpler for pretty much any tipped worker in a qualifying job to get this deduction. All right, let's switch gears and talk about our second new tax break, the overtime deduction. This one is all about giving a break to the millions of workers out there putting in those extra hours. Now listen up, because this is super important. You can't deduct your entire overtime paycheck. The deduction is only for the premium part of your pay. That's the half in time and a half. And it has to be overtime that's required by the Federal Fair Labor Standards Act, or FLSA. So, any extra pay your company gives you beyond that, like double time, well, that doesn't count for this deduction. For all you single filers out there, the maximum you can deduct for your overtime premium is $12,500 per year. Again, that's a really substantial benefit if you qualify. And if you're married and you file a joint return, that maximum deduction doubles to a massive $25,000. And, just like with the tips, here's the tricky part. Your pay stub might not break out the exact deductible amount for you. So the IRS has given us a few reasonable methods to help you figure it out. This chart pretty much spells it all out for us. So if your pay stub has a line for total overtime and it's paid at time and a half, you just divide that total by 3. Simple. If your company pays double time and lists it as total overtime, you divide by 4. And if they pay double time but they list it as an overtime premium, you just divide that premium by 2. These simple formulas are your key to this whole thing. To make this super clear, let's walk through a real-world example straight from the IRS notice. Let's meet Carol. She's a law enforcement officer, and that's a profession with some pretty unique overtime rules. So Carol earned $15,000 in total overtime pay, and it was all listed on her pay statements. Since her overtime is based on that standard time and a half rate required by the FLSA, she gets to use that simple divide by 3 rule.
She takes her $15,000 total, divides by 3, and boom, she gets her deductible amount, $5,000. It really is that straightforward.
Phew! Okay, so we've covered the what and the how for both of these awesome deductions. Now let's wrap up with the fine print that applies to everybody and your action plan for next year.
Now, one of the biggest rules you got to know about is the income limit. For single filers, the deduction starts to phase out if your modified adjusted gross income, or MAGI, which is basically just your gross income with a few things added back in, is over $150,000. For joint filers, that number jumps to $300,000. So yeah, these deductions are really aimed at middle-income earners.
All right, let's quickly run through 4 final rules to keep in mind. First, if you're married, you have to file a joint return to claim these, no married filing separately. Second, you have to include your Social Security number. Third, and this is great news, this is an above-the-line deduction, which means you can take it whether you itemize or just take the standard deduction. And finally, just remember, this is a temporary benefit. It's set to last from 2025 through 2028.
Okay, if there is one single thing you remember from all of this, please let it be this. Because the official forms aren't ready, the responsibility to prove your deduction amount falls completely on you. The single most important thing you can do is keep meticulous records.
Okay, you ready? Here's your game plan for 2025. Starting now, save every single pay stub. If you're self-employed, you need to keep a detailed, daily tip log. It's also a really good idea to just ask your employer if you're an FLSA-eligible employee, just to confirm you qualify for that overtime deduction. And please remember, these special calculation methods we talked about, they're only for this first transition year, 2025.
Look, this is real money we're talking about, money you worked hard for. So the only question left is, when tax time rolls around, will your records be ready to help you claim it?